So first of all, thanks for joining us here on the institutional stage. We're really excited to be talking about adapting strategies in an evolving market. How is the generating alpha process changed with technological and financial innovation that's been going on? So before we dive into the depth of generating alpha with respect to outperforming on Bitcoin, in a traditional sense, when we talk about generating alpha in a portfolio, it's really about adding a bit of risk into an existing portfolio of bonds, stocks, commodities, real assets. And the argument for many years has been that Bitcoin is an asymmetric return asset, which means there is a possibility that it goes to zero, and we all end up saying this was some very odd financial experiment, or we're at a point where we're $100,000, $1 million plus a Bitcoin. So, that discussion's been going on for portfolio allocators for many years, but now we're going to get sort of into the depth of generating alpha versus Bitcoin. So we'll start with a quick introduction to the panelists. We'll talk about the current state of the market, existing strategies, and then looking to the future. So first of all, Neil, would you like to kick us off?
Sure. My name is Neil Van Huis. I'm the Director of Sales and Trading for Blockfills. Blockfills is a global financial services technology and trading firm out of Chicago and London. We provide technology, liquidity, and clearing services for professional traders and institutions.
Hi, everybody. Danny Kim here. I'm the Head of Business Development at SFOX. We're one of the first U.S. prime brokerages in crypto. Pretty much we just aggregate all the main liquidity providers and provide a single point of access for liquidity.
Hey, I'm Michael Safai. I lead Dexterity Capital. We're a market-neutral algorithmic prop shop.
Hi, I'm Jakob Palmstierna. I'm with GSR. We're a market maker and trader in the crypto space.
Okay, great. So let's kick off with a really straightforward question, which is, are institutional investors, are real grown-ups getting involved in the space in generating alpha? Jakob?
Well, I think that we have seen for a few years now, albeit small, but there are hedge funds in the traditional space, particularly people trading in the future space. They have small exposures on directional alphas on BTC, which I guess is sort of the clearest sense of institutional participation. So one of the reasons they do this is whenever a new contract gets launched, a new data series is created. Even if it doesn't going to affect a big part of your portfolio, say you're trading 120, 130 futures markets and you're trading $5-10 billion, trading a BTC contract, even though you're doing fantastically well on it, is not really going to change your P&L materially. But what you're doing is that you are becoming part of that price series, that return series, so that once that contract matures, you can take out your own trading from it and then do an analysis on that price behavior without you in it. And that's extremely valuable if the contract grows to maturity. So that's what we have seen.
Yeah, I think Hi. Yeah, I think before, let's first define what institutional investors are, right? I think generally institutional investors are pretty much any organization or any entity that is representing a pool of buyers or sellers. And today you're seeing, that represents typically your hedge funds, your banks, pension funds, endowments, and so forth. In this market today, you have been seeing a couple of institutional investors quite for some time. Now it all really depends on exactly where you are, where you're located based on the regulatory front. On the U.S. side, it's mostly been more of the prop trading shops who've been involved, a little higher frequency shops getting involved. Hedge funds, it's all about basically up to what their investment prospectus is. On the banking side in the U.S. at least, I think there's still a lot of regulatory hurdles they need to get to, more clarity before those institutional banks come in. And that's kind of what we're seeing on our end.
Yeah, I'd just add that, we see very much similar. A lot of institutional investors, we kind of look at it more as groups of them. we find that there's a lot of active traders that have been around 20, 30, 40 years that are institutions themselves, but they're more on the active trading side. On the buy side, there are definitely fund of funds that are allocating into the space for more active traders, but also some banks and asset managers.
Yeah, it's really interesting because the data in this industry is quite hard to get clarity on, right? So I know Crypto Compare, we've got to plug them, it is their conference after all, have a fantastic exchange report to try and give us an idea of the exchange traded volumes. At ByteTree we do on-chain data to look at flows on-chain. You've got people like Skew doing the derivatives market, but how do we really know that there is this activity taking place? I'm guessing a lot of it's coming from the OTC market. That's where a lot of the flow is coming through, and that's a black hole in terms of getting any visibility. So I know while we have some cracking OTC companies here, I'd love to get your opinion on the size of that market with respect to kind of the total volume that's being traded in the crypto asset market.
Jakob, do you have a sense of size? I don't know if I could get directly into numbers of size of OTC trading. It's still a little opaque, but I think today you'd probably find that it's much more diverse for execution than you might think. I think there's a lot of OTC desks that have emerged out of exchanges, like Kraken. They've grown quite an extensive OTC desk, but I mean. Today, the real question is, are you facing an entity that's just acting as a brokerage house, or are you actually, facing an OTC market maker who's actually taking principal risk? Is it just execution, or is it actually OTC principal trading? And I think that those terms are frequently too loose. And so today, I think, and maybe one of your follow-up questions will be, what is the risk associated with working with, let's say, an OTC market maker is actually taking principal risk versus just an execution desk?
And when you're talking about OTC, I mean, like you were saying, there's a whole variations of different types of OTC. OTC for crypto, that was probably one of the first transactions of crypto, right? OTC stands for over the counter, and it's pretty much peer-to-peer. And if you take into account what OTC volume is, I mean, if you're looking at basic peer-to-peer transactions, that's local Bitcoins, Paxful, and a whole bunch of others. And then you have more of the institutional OTCs that are coming in. Generally, what Mark has shown or said in the past, it's, there is a lot of volume that, you can't really quantify, but a lot of what people would say and have shown in reports, that it does represent a significant volume of what's actually being traded on a day-to-day basis. I mean, it could be on the institutional side, it could be on the individual side, but, like one of the things about crypto that everyone loves is the fact that you can easily do a transfer of transactions, person to peer to peer, and I think that's that's part of the growth of what you're seeing.
Yeah. Okay. Brilliant. So it's growing. We don't really know the size, but it's definitely active. And I think the reason it becomes really relevant is because it facilitates the speed that people can move crypto assets through the ecosystem, which obviously helps with alpha generating strategies. So I think we'll talk now a little bit about the sort of strategies that have been working in the industry for the last many years, maybe 5+ years. One that comes to mind is arbitrage. That we saw in, I think it was January 18 in South Korea. Bitcoin was at a 43% premium at one point. Now, not all that could be realized, but there were huge options for arbitrage. So, who wants to take a question about sort of arbitrage between centralized exchanges?
I can give that a shot.
Michael.
I think, back especially in 2017 and 2018, there were lots and lots of ICOs, lots of coins, and lots of exchanges. If I want to go buy a share of Ford Motor stock, I've got one place to go. It's the NYSE, fundamentally. If I want to buy Bitcoin, I've got dozens of venues, each with their own liquidity, each with their own fee structure, each with their own withdrawal rules. So there were lots and lots of opportunities to capture arbitrage between them. And again, when there were tons of ICOs and stuff, there were lots of different coins with very limited liquidity that you could pull a lot of tricks with. And, you can kind of take it to another layer of sophistication with what we call a triangle, where you look at 3 books and you try to make a little money on your turn. I have a Bitcoin. I trade it for Tether. I take that tether and I trade it for Pax on a different book, and then I trade the Pax bat for Bitcoin on yet another book, and if I've done it right, I end up with more Bitcoin at the end of this process. I can do it in 60 milliseconds. And because there are so many stable coins, there's just tons and tons of triangles right now. So I think, there's certainly some types of arbitrage are gone. For example, the South Korean one, not so prevalent anymore. But there's lots of other ones that still remain.
Yeah, and just to add to that, it's, when you look at arbitrage, you got to first understand what's the reason, what's the cause of arbitrage. And a lot of it really stems from inefficiencies in the market, right? If you look at, say, for Korea or Brazil, it's the fact that there are rails or, lack of permissions of being able to transfer funds. Korea has the capital controls, same thing with Brazil, and then there's inefficiencies of trying to access that. So what we're seeing in arbitrage, when in crypto itself, when it first started, that was primarily because, some of these exchanges just didn't have that infrastructure to provide efficient markets, right? And so when you were sending money to, say, Mt. Gox or Bitstamp or like ItBit, it's because it took about like 1 to 2 days to transfer funds. And by that time, you may see an arbitrage, but can you actually capitalize that or not? As markets have developed, you're seeing this in Korea and internationally, where there are more sophisticated, say, trading shops who are coming in who already have the rails built out from previous trading activities from these countries to actually capitalize on it. So I think when you're looking at these arbitrages, you actually need to realize, are these true arbitrages or are these fake arbitrages? Because when I say real, they have to be able to be captured. And you're also looking at some of the things where, you'll see these arbitrages on exchanges, but now when you're seeing what you're seeing on the data side is purely the top of the book price. It's not taking into account actual trading fees. So when you actually take the net price, that's what you got to consider. So I think those are the various different considerations that come into play.
Oh, I think you're right, and there's an added component to that is arbitrage is traditionally deemed as something that's a riskless profit, right?
Yeah.
So going out and trading across 20 different exchanges or even 5 exchanges that are in different geographies, different fee schedules, different banking components or no banking components, that there actually is a risk that you're taking, that maybe you don't get your asset back or maybe your funds get locked in a geography or a location that you're unfamiliar with. That poses a different risk to the equation than normal. A trading opportunity is different than an arbitrage. And so, yes, we do see inefficiencies all over the place, and they still exist in some places, but how much risk are you taking to achieve that trading opportunity is a component that some people don't like to factor into the crypto ecosystem. And so I think in the future, what we hope for in our venue is that it'll be less about arbitrage and it'll be more about fully executable liquidity, best price execution from an agency business, and mitigating counterparty risk.
Yeah, no, it's actually funny you say that because I actually had a client where they saw an arbitrage between the US and Korea, didn't understand the rails of it, the execution. He actually got stuck in Korea and couldn't get funds out. And it was actually a significant amount. And it's been there for about 6 months, and then he was finally able to trickle it out.
Okay, so aside from arbitrage, what other opportunities have we seen over the last few years? High frequency trading, quantitative strategies. What's been the success story, or is it just a buy and hold?
I think per definition there is an element of decay in every alpha that you trade. So arbitrage, you start trading it, the arbitrage disappears. That's why market becomes efficient. We can still see some arbitrage opportunities out there. I think the biggest risk that you are running is the mathematical opportunities are there. The operational risk is huge. So you're basically picking up pennies, and you can get absolutely rolled over by just one of your legs getting stuck on an exchange. And it's happened more than once for us. Another way of looking at, I have to be slightly careful about what we disclose, but similar to a microstructure trade like arbitrage is lead lag effects. So across different exchanges or different venues, across derivatives versus spot, there is a slight differential in timing versus prices are moving. And that opens up for opportunities if you can capture it with the amount, with the right amount of latency to get ahead of the price movements on certain venues. They are very similar. They also come with a lot of exchange risk. But in all, at least what we are trying to do is to have a wider set of so-called alphas that we are trading, some of them being in the microstructures space. We don't really need to backtest that much. The other things that we are doing are more directional or relative value based, but I would call them more as predictive alphas, where you're trying to spot an anomaly within the market structure, and you're trading on some form of consistency across correlations, some autocorrelation properties over certain timing, and then it all comes down to implementation. How quickly can you get in and out of position? How can you size that?
Yeah. Just to add to that, I guess it's that these alpha strategies are starting to change and get developed. A lot of it comes from the maturity of the market, right? Like before, when you were the information or products you were able to trade on, it wasn't actually readily available. Now you have a lot more data, you have a lot more sophisticated products coming out where you can actually start generating a little bit different strategies of alpha, right? And what we're seeing in different types of trading strategies from different funds, it could be on-chain analysis, it could be market momentum, like market events. It could also be, like you said, like on the arbitrage, but not just spot exchanges, but on different products, right? You could see the opportunities between, saying, an options product coming on and developing a fixed income product. You can trade on a futures product and see if there's any type of price discrepancy on it. You have Grayscale, who came out with their GBTC product for quite some time, and there was always an opportunity over there where you're trading against what the spot market is versus what they're trading on their premium. So when they are rebalancing, there's that opportunity to capitalize on. So I think what you're seeing right now is that as markets develop and mature, as more information gets more readily available, especially on the data side, there are going to be more tools that you could actually capitalize on and develop. I think what we're seeing right now is you're still probably in the second or third inning on market development, and you're seeing a lot more of these new shops come in because they're seeing opportunities that they can carry over from traditional side and bring into the crypto side. But that's only required or possible as infrastructure and tools are created and available.
That's what's really exciting for the industry. When there are opportunities that can take enough capital to tempt other external shops that otherwise wouldn't be touching crypto. Yeah. And actually, so we on the technology side. We talked a little bit earlier, Michael, about decentralized exchanges and arbitrage solutions. And I know you guys at Dexterity Capital have done something pretty exciting in the past, so it might be good to talk about that.
Yeah, and I think ultimately when you're trading, you're trying to make alpha. It's all pretty similar across the board, but centralized exchanges and DEXs or decentralized exchanges are quite different. I think I kind of compare it to poker. If I'm on a centralized exchange, I'm playing draw poker. I know my opponents are out there. I can't see their cards. I can draw some inferences from whether they raise or call or whether they're sweating or what have you. But I don't know a lot about them. And that's what's happening on a centralized exchange. I don't know who my competitors are. I know their orders are on the books. I can examine the books and kind of figure out what they're doing, but it's all pretty opaque. DEXs, on the other hand, are kind of like Texas Hold'em, when you've got a bunch of face-up cards on the table that everybody can share and use. If I see a really exciting opportunity on a DEX and I try to make the trade, I've got to send that order to the blockchain. And let's say it's Ethereum, and I specify some gas price with that order. I've got probably maybe 15 seconds, or up to 15 seconds, before that gets mined and made concrete. It doesn't get executed instantly. So if somebody else is really clever, like the guys at GSR, for example, are watching out and they see my order and they like it, they can try to steal it. They can try to front run me effectively. And they'll do this by increasing the gas price. If I pay 20, they'll try to pay 40. And if I'm just as clever as they are, I'm watching too. I see them counterbid, and I bid with more gas myself. And we play this game kind of going up the pole until either the profit's gone or somebody wins the trade. And this can get really nasty when some people just want to, on the Ethereum blockchain, I can see how much money you've got in your wallet. And if you've got $1 million and I've got $500,000 and you want to drive me out of business, you can by eating up those profits, because no matter who wins the transaction, we both pay the fees to the miners. So it's a very different game because it's public. Everything's visible to everybody. You can't hide what you're doing.
We don't trade on DEXs, so I'm learning things.
We don't either too anymore, thank God. But yeah.
I might do now.
How's the liquidity on DEXs?
You know, we did it back in late 2017, 2018, when Bancor was big and Ether Delta was still a big thing, and it was great because the profits were huge. The liquidity wasn't super deep, but it was a lot of money. It's not so much the case anymore. The centralized exchanges have kind of won that war for the most part.
Well, yeah, and that's one of the tough things about a DEX, right? Is that liquidity generally is centralized, and so being that there's this competitive nature to the DEX. It can be an issue in terms of liquidity as it evolves, or as, let's just say, what we've seen in centralized exchanges, there's so many venues. You get so many decentralized venues, liquidity, again, gets more and more fragmented across those things. And it just becomes will it take off? Will there be enough opportunity to go around? Will it be worth your time and effort, for generating alpha?
Do you think generally, like, when you're trading, based off of what you said about the ether gas competition, is there more edge in you getting it on decentralized exchanges or centralized exchanges based off of how you're trading on DEXs versus centralized?
Well, I mean, for us, we don't do DEX anymore just because the liquidity is not there fundamentally. But I will say it's even more than just optimizing the gas price. You also optimize how you use gas. There's a thing going around called gas token, which is if you were really good at writing your contracts, you could spend less money and get the same amount of transactions executed. So it was a really complicated game.
If this is a topic that you find particularly interesting, I think Stanny, can't pronounce his second name, from Arve is doing a talk on flash loans later on the DeFi stage, and that is an extremely exciting area of our space. We saw 2 profitable trades summing to $900,000 made within a single transaction with absolutely no capital at risk. So it's a very exciting area of the industry where you can get involved with a lot of smarts and not having to put capital at risk and still turn a profit. And I think those kind of opportunities will draw in new minds and money into the space until these inefficiencies over many years get competed away and we have a fully decentralized finance system. So do we have any questions, first of all?
Yeah, so relative to the alpha performance, where would you guys say that relationships with the exchanges matter? I.e., your sophistication relative to the fee structure that you actually traded?
So sorry, was the question was the based on the type of strategy, how much does a relationship at the exchange matter? I actually do think that being that we're not an exchange, but we're more of a hybrid model, kind of like a decentralized approach with centralized liquidity. We think that it's extremely important that you have this kind of almost bespoke on a case-by-case relationship with a client that, for example, what we're seeing on derivatives exchanges is a benchmark rate, a trade goes through at Coinbase and it liquidates, a whole portfolio on an exchange because the benchmark rate isn't really stable. And so what we'd like to achieve in the future is, create tools, products around such things like funding rates and derivatives that, make it possible to be more like a traditional clearing firm that might say, listen, I know your balance is across various positions. I know you don't need to be blown out here. Can you borrow through, let's say, a repo rate, to get you through the next 8 hours of funding? Those sort of things come from discussions with teams like GSR that are creating products out there for a bunch of participants, going out to the community and finding out what people need and then building those things and always making sure that you're doing right by your clients. I think that's a big deal. And in exchange, when you've got 4, 5, 10 million clients, it's extremely hard to have a pulse on that.
Yeah, and to add to that, it's it really depends on what strategy you're running. If you are doing an arbitrage opportunity, then you are price sensitive and you are fee tier sensitive. So then you want to negotiate as low of a cost as possible for the exchange because every penny, every dollar matters. So it really depends on exactly what type of strategy you're running that would matter for the relationship with the exchange.
Yeah, I'd agree. Relationships are super important. As you said, kind of fees and negotiations. Another thing is that exchanges are pretty immature still. They've kind of all built minimum viable product. They're iterating. They're growing fast. but they're not super stable. They go down a lot more than compared in the traditional world. Having a Telegram chat open with the right person at all times that you can ping 24/7 and say, hey, our WebSocket's down, why, is a big advantage.
I mean, you know this as well as anyone else, but fees are extremely important, and the amount of times where you have a great strategy that seems to be printing, you just don't get over the fee hurdle. If you're making, so you just put in passive orders, you're not getting enough fills. Let's say you're paying nothing for that, but you're just not getting enough fills. So basically the exchange is running away for you. It's changed behaviors once you put your orders in. On the other hand, if you start taking those orders, either they disappear, whatever you're trying to take, or you just don't get over the fee hurdle that's imposed on you. You try and get a higher fill rate, you aim a little bit further into the book. But all of those things, I mean, it's not a fixed immutable object, these exchanges and the behaviors of these exchanges. They do change as you impose a new strategy, and you're basically just chasing in this little wheel the whole time. So every single time, even if you have the fundamentals of a strategy, changing the way you trade that, getting ahead of the different market microstructure properties are very, very important. And the way that we do it is that, I mean, we have to have a set number of exchanges that we think behaves better than other exchanges. Yeah. And, we take targeted one and we give it our best shot. Then we move to the next one. What we try not to do is just to scatter ourselves around and try to do everything at the same time, because it takes a lot of time.
And in terms of the technology innovations, I mean, will the relationships become less important with individual exchanges when we have platforms that can interact effectively with multiple different liquidity venues, exchanges, OTC, and other, and also pool liquidity, between retail and institutional, which I hear is good pickings for the institutional guys.
Well, likely it'll change back to kind of like a immature, even more immature yet again, because if some of this trading goes into professional venues, which has been a little bit of a trend, right, and then they find that it's much more efficient to do business there, kind of like how dark pools work institutionally for other asset classes, then perhaps the liquidity becomes worse again yet on retail exchanges, because the only alpha to generate is to make retail pay for slippage, so that you can go lay it off better in a lower cost professional ecosystem. So, again, are exchanges properly set up to help institutions, or are they really just this foundation for retail to access the market?
I think we're seeing the merge towards the first. I mean, Kraken, I think Binance now as well. I think Bitstamp are talking about it as well. So sort of bringing together the two pools. And SFOX have got some interesting technology around allowing their customers to exploit these differences in prices. Is that right?
That's right. So one thing that we've seen and developed was, there is large market fragmentation, right? And one of the pieces that we always figured was, for market access, in order for adoption, you need easier market access, regardless if you are retail or you are institution. And so the idea was aggregate most of all the major exchanges, do the due diligence of security, the onboarding and everything, and then also bring in more institutional flow that comes from OTC and so forth, so that you can provide a full price discovery, where if you come into one platform, you can execute from one single point of access without having to have an account, but then you can also see, actual price discovery of what's happening on actual exchanges along with OTC. And that's the big development of it, right? It's, if you want markets to grow, you want those infrastructure, that foundational level to happen. And that allows not only the retail side, but even new businesses to come in, where you see these challenger banks or you see these payment companies that need these tools to build on top of. Because for them to actually do this direct integration with all these different exchanges and liquidity providers, it becomes quite cumbersome. And that's why I think there's platforms like ourselves, Blockfills, and other guys, where we're providing that ease of access to liquidity.
Okay, brilliant. I think that's all we've got time for. Thank you very much, gentlemen, for joining us, and thank you all. Have a great day.
Thank you.